Friends, let's get started. I wanted to go over with you how you can understand if it's the right time to refinance, or because there's a ton of other lenders on this call, other real estate professionals, how you can relay this information to your clients, your friends, your family, your sphere about a refinance, because it really isn't something that anyone should be scared of. It's not a scam. There's nothing negative to go with it, but I'm going to explain what the risks are today so that you'll properly understand them. And by understanding the risks, you'll know how to avoid them. It's that simple. Now, a lot of you guys know what a refinance is, but just in case, or because there's a ton of misinformation out there when it comes to financial concepts, let me explain how a refinance actually works. A lot of people think that a refinance is changing their existing mortgage to reduce the payment. That is not a refinance. A refinance is a whole new mortgage. You're taking out an entirely new mortgage that pays off the existing mortgage against your house. And you can do this on your primary residence. You could do this on your rental properties. You could do this on your second home. Any mortgage can be refinanced. It's paid off in full and a new loan comes in and replaces it. So that's refinance 101, is understanding that you are in fact taking out a new mortgage. And the reason that's important to understand is you have to think about restarting a 30-year term. And does that really make sense for you? A funny thing happened in 2020, 2021, refinances were everywhere. Everyone was talking about them. More than half the country qualified to refinance and it made sense for them to do so. And they were all actually trying to do so at the same time. I forgot to refinance myself during that time because I was so busy. And when my husband was really mad at me, I did a total cost analysis for myself and I showed him. There's something that happens in year 7 or 8 on many mortgages where you flip to paying more principal than interest. And we had bought our house with a really low interest rate of 3.25. So he was wondering why I didn't refinance to something in the 2s. And I was able to show him the total cost analysis of how far we were into our mortgage, that restarting on a 30-year term, even with the lower interest rate, didn't make sense. I didn't have to admit that I had just forgotten. But I'll explain why this total cost analysis is so important and how you can use it to not be nervous about your refinance and make sure it really makes sense. First, I have to explain why I thought that it was important to do a webinar on how to avoid refinance scams. The reason I think this is such a risk right now is, well, let me back up and explain. So in 2020, 2021, money was like raining from the sky for mortgage companies and loan officers. And they got used to it. They really liked it. Like, that's nice when everyone wants to refinance and it makes sense for everyone. No scam needed. Like, there's a big drop in your interest rate. You're going from 5% to 3%. That's a no-brainer. Then that quickly changed. And so a lot of lenders were kind of caught with their pants down. They weren't used to having to work in a much more difficult market with rising interest rates and high home prices. So you can imagine what kind of position that put them in when it came to their business. At the end of 2023, at the end of a really, really hard year, we saw some improvement on inflation. And then the word on the street, the speculation was that the Fed was going to cut interest rates 4 times in 2024. Everyone got really excited. They popped the champagne bottles early. Mortgage companies specifically, you may not know this, but there are some companies that pop up just to take advantage of a refinance market. They set up a call center, they hire a bunch of brand new loan officers, processors, underwriters, and then they send out mailers and they wait for the phone to ring. And then they capitalize on the refi, boom, and then they close. They go away because they don't want to work in the market that we've had to work in for the last 2 years. So they started capitalizing on this. They started getting ready to capitalize. And then it didn't happen. Rates didn't come down. Here we are in August, and there hasn't been 4 rate cuts. There hasn't been 1 rate cut. So payroll, the P&Ls haven't been looking good for these mortgage companies. So when we saw a little bit of a drop in interest rates 2 weeks ago, never mind that the week right after they ticked back up, the mailers started, right? They were like, listen, we've been waiting on the edge of our seats. We need to start making some money on these refis. So they started smoking your phones. I've had so many clients reach out to me and say that they have been solicited for a refinance. And it doesn't make sense yet, guys. Not just because rates are going to get better, but because of everything I'm going to go over with you today. So how do you know when rates have come down enough so that you don't have to rely on me to tell you? Because I'm sure what all you guys are thinking, especially the other lenders on the call, is, well, you want to refinance people too. You want to make money off of refinances. Yes, I do. I like to make money, but I don't want to refinance anyone to put them in a position where they were worse off than they were before. That's called a fiduciary responsibility that we have to our clients. We have to do what's right for them. And part of that is education. So we're going to do that today. Our agenda for this very quick little meeting we have together, for our short time together, is to go over a total cost analysis so that you understand what I'm talking about when I analyze restarting a 30-year term and the total closing costs that you're incurring, your new loan amount, and what your net savings are going to be. We're going to make sure that you understand how, once you've received a total cost analysis from your lender, how to make sure that your loan estimate actually matches what you were sold. We're going to go over how to analyze your new loan amount, and then something that a lot of people don't talk about, which is what to do with your escrow account. Your escrow account, if you include taxes and insurance in your mortgage, your escrow account is like that holding space for those. So every month when you pay your mortgage, you pay 1/12 of your tax bill and 1/12 of your insurance bill, and then the mortgage company holds it. There's not interest paid on this. There's not a fee. They hold it for you so that they can pay those bills when they come due. And that's less liability for them, because if you were responsible for paying your insurance or your taxes and you didn't, then, the county could foreclose on you. Or if there was a fire and your house burned down and you didn't have insurance, you'd be less likely to keep paying the mortgage on a house that doesn't exist, right? So lenders actually like to do this for you, but you build up money in this account. And then what happens to it when you refinance? I'll explain. So let's start with this total cost analysis thing. This is a tool I use for every single client on every single kind of mortgage, whether it's a purchase or a refinance, whether they're buying their dream home or an investment property. I'm a highly opinionated person. You might know this about me. So I like to tell people what to do, but sometimes the numbers surprise me. And what I've learned over the past 12 years in doing mortgages is that numbers are better than opinions. So I rely on a total cost analysis to truly tell me, like, what's the best option on a monthly basis? What's the best option over the next 5 years, the next 15 years? How do I make sure that the advice I'm giving is not just rooted in opinion and experience, but also has numbers backed up to it? One of the most common talking points about a refinance is, how much do you need your interest rate to drop in percentage-wise in order for a refinance to make sense as a rule of thumb? I think that's kind of a stupid question because it's case by case. I don't really care for rules of thumb. I think you got to run the numbers every single time. It's totally case by case. So let's look at my clients who did a jumbo loan. You would think a 0.5 point drop on a $950,000 loan would be more than enough to meet a net tangible benefit test. I'll explain what a net tangible benefit test is in a second, but let's first just look at the monthly payments. So we have a huge drop here from 7.5% to 6.625%. That's big. The monthly savings are beautiful. I mean, what would you do with an extra $500 a month? Maybe you'd save it, and after 6 months, you'd buy a designer bag. I'm not telling you what to do. I'm just saying there's ideas here, right? $500 a month is a lot. But if we go back, some of you might have noticed. So here's that beautiful monthly savings of $500 a month. I mean, just brainstorm. What would you do? But you might have noticed that the loan amount went up quite a bit. We're talking about $17,000. I mean, that's a lot of money. So we got to see what's going on with the new loan amount. We need to analyze our new loan amount before we refinance. These are the costs that are being attached in that refinance. So they have to get another appraisal. Now, appraisals when you own the home and you're refinancing an owner-occupied primary residence, there's a good chance your appraisal is going to get waived. And in my market specifically, we're seeing the cost of appraisals come down. This is, again, just supply and demand. There's less demand for appraisers. Oh, let me stop here and explain the cost of an appraisal, because this is like the wild, wild west. So mortgages are heavily regulated, and every cost that we disclose to you, if it changes within a tiny percentage amount before we close, we have to redisclose everything, and then there's a new wait period, and blah, blah. Appraisals can charge whatever they want. So following the housing crash, appraisers came in, there was AMCs that stepped in, and they're supposed to be the neutral third party so that I can't just pick an appraiser I like who does a good job and delivers his report on time, because I might be trying to influence his value. So now an AMC has to come in the middle. This costs money. So the AMC charges the consumer a fee, but the appraiser is still the one doing all the work. So they also have to charge a fee. So 2020, when there was so much demand, appraisals were costing well above $1,000 on a basic track home. The cost is coming down now because we're in a different kind of market where appraisers can't be extortionists. So we're seeing appraisals come down to like $550. On a jumbo loan, an appraisal is not going to get waived. On a conforming loan that you occupy with a decent amount of equity and you have a good credit score, and in the neighborhood they can do a good automatic valuation, your appraisal might get waived and you would avoid this cost when it comes to a refinance. This is an existing client of ours, and so I waive our bank fee when we handle a refinance for an existing client. So you'll see that. Then there's title and escrow fees. So when you purchased a home, title and escrow fees are pretty substantial. They're the largest part of closing costs. The new title policy, the owner's title policy, the lender's title policy, all the miscellaneous fees they charge, notary fee, wire fee, document prep fee. If you use their bathroom, there's a fee. There's a lot of fees that come when you buy a house from the title company. But when you refinance, it's just their escrow fee to handle it and a new title policy and then recording the new deed. So they're much less. But we're going to talk about the escrow account too. So as we mentioned, you have an escrow account attached to your mortgage if you choose to have them pay your taxes and insurance, which is the majority of mortgages and homeowners out there. When we do your refinance, we need to refund that account because, as I mentioned, we're setting up a whole new mortgage. Your existing mortgage will be paid off and closed. New mortgage means new escrow account, and those bills might be coming due soon. So we can't start from a zero balance. We have to fund the new escrow account. You have a choice here, and a lot of people don't realize that. You can choose to have your escrow balance transferred through the refinance or refunded to you. If you choose to have it refunded to you, that's fine, but it just means a slightly higher loan amount on your refinance because we have to fund the new account, and we're going to use your new loan amount to do that. Again, something you can't do on a purchase. You can't finance this stuff. Closing costs have to be paid or come from a seller concession or a down payment assistance program. On a refinance, your new loan amount can absorb closing costs, and some of those closing costs may be taxes and insurance to fund your new escrow account. If you want to have it transferred over instead, that is the best way to keep your new loan amount down as much as possible. What happens then is your current servicer will credit the escrow balance towards the payoff. Then we'll still collect reserves to fund the new one, but the amount required to pay off your old mortgage went down. I hope that makes sense.
Shivani, I have a quick question.
Sure.
Can
Who
you
is that?
explain-
So I don't mute
This
you.
is Hema, sorry.
Hi, Hema.
Can you please explain the transferring of the escrow over again?
Yep. So when we go to pay off your current mortgage, we're going to request a payoff statement from the company you're making your mortgage payments to now, because the balance on your mortgage statement is not the payoff amount. On a mortgage, interest is paid in arrears. So we need to get a payoff statement from them, or payoff demand, showing exactly the amount required to pay it in full. If you have mortgage insurance, there'll also be 1 month of mortgage insurance required. So it'll be your balance, 1 month of interest, 1 month of mortgage insurance, payoff amount. If you want to transfer your escrow balance, they credit the amount in your escrow account towards the payoff amount.
Oh, okay. All right, that
So it
makes sense.
reduces the amount required to pay them in full. We still fund a new escrow account on this side, but the payoff on your mortgage went down by that amount.
Got it. Thank you.
That's a really good question. So it's pretty simple, right? You look at the costs, you look at what's happening to your new loan amount, and it's not rocket science. You can then see, based on what I'm saving on a monthly basis and what cost I'm incurring to refinance, how quickly will it pay for itself. So you may or may not know this, but to be a loan officer, you don't even have to have a high school degree to do this job. So I know that everything I'm telling you is not rocket science, because it's not rocket scientists selling the majority of the mortgages in this country. Here I am in grad school, which is besides the point, but the thing our job requires may not be a ton of education, but it does require honesty and transparency, or at least it should. So I mentioned saying a net tangible benefit test. Politicians and lobbyists are really good at protecting Americans. They always have Americans' best interests at heart. So this is what they came up with. A net tangible benefit test is a rule that applies to refinancing mortgages and requires that the new loan provides a financial benefit to the borrower. That's great. That sounds good. The test is a safeguard against predatory lending practices. I'm down with that. I don't like predatory lenders. And is required by many states and the federal government. The borrower is responsible for determining if the new loan provides a net benefit. Ooh, that's tricky, right? Because does the borrower know? Do they have enough education? Have they gone to a how to avoid a refi scam webinar and understand how to analyze their new loan amount and what to do with their escrow account and what the payoff on their mortgage is going to look like? Probably not. So I like to do my own test, and it goes like this. How long do you think you're going to be in the loan? I ask everybody that. And maybe that means before you refinance again. For all my buyers right now, we're looking at a long-term comparison of loans and strategies over the next 5 and 15 years, like I mentioned. But then I also add one additional term that's specific to the market we're in right now. We run the numbers over the next 2 years to see which financing strategies, because that's when I think the bottom of interest rates is going to be, sometime in the next 24 months. For this particular client, this is actually their forever home. Famous last words, right? I've heard so many clients say, this is going to be my forever home. And then in 2 years, they call again and they need to get pre-approved. But for right now, these people feel this is their forever home. So they have full confidence that they would keep this loan at least the next 5 years. And he just bought it 6 months ago. So I looked at the savings over 60 months. And these are the true net savings after taking into account all those costs we just went over line by line. But there was points attached to that interest rate. I'm going to go back and show you because I didn't talk about it. And a lot of lenders won't talk about it. If you look in the bottom left of the screen, there's $12,000 in points attached to that interest rate. That's not an exorbitant amount of points, guys, on a jumbo loan. It's less than 1 point is what he was going to have to pay for that beautiful interest rate that saved him $500 a month. But it is a lot of money, right? But even after I take it into account, he's saving $26,000, true net savings after considering his new loan amount, after considering restarting a 30-year term. All costs in, his net savings are $26,000 over the next 5 years. But what if we waited just a little bit? And this is what I do. I analyze the economy all day long to the point that it is quite anxiety inducing. But I want to know, how likely is it that he could get that rate without any points in the near future? And my professional opinion is that it's highly likely that within the next few months, especially, well, hang on, let me go in order here. A call center loan officer is not going to tell you this, right? Because they need to hit their quota today. They need to sell mortgages today. And you're looking at saving $26,000 over the next 5 years. That's beautiful. Do it. $500 a month, $26,000 over the next 5 years. Let's go. No, though, because I think you could save more if you wait just a couple months and get that rate without points attached. I don't have a crystal ball. It's true. But like I said, I'm watching this all day long. I'm listening to economists outside the housing industry for what they're saying is going to happen, because a lot of the people that we hear from, bless their hearts, all of them, they're being paid by our companies to give us advice on a daily basis. So obviously whatever advice they're going to give us is whatever makes me not want to jump out my office window today. So I'm listening to opinions from a lot of different places on what's going to happen. And I do think a better refinance opportunity is on the horizon in the near future. And it's not so much about the Fed rate cuts in September. I think the Fed futures market thinks with 100% certainty that there's a rate cut coming in September. So now the only debate is whether the Fed cuts 25 basis points or 50 basis points. But I don't know how much that's really going to move the needle on rates. The labor market is what I'm watching. I think jobs numbers will move rates, just like they did this morning. We saw initial jobless claims come in lower by 7,000, and mortgage bonds gave up 30 basis points of the improvement we had gained over the past few days. So let me explain how interest rates actually work. So a lot of people think that it's just the Fed cuts rates, mortgages get less expensive. It's not necessarily true. The Fed funds rate is the short-term rate. It's the rate for credit cards and HELOCs. Those will immediately improve. Mortgage interest rates surely do react to what the Fed does, but mortgage rates are determined by the supply and demand for mortgage bonds. And in times of certainty, investors put their money a lot of different places. In times of uncertainty, investors like bonds. So when there's a lot of supply for mortgage bonds, interest rates improve. Well, if we're headed towards a job loss recession, if the job numbers look weak, if the labor market begins to struggle, there's more demand for mortgage bonds, and we see mortgage interest rates improve. So, insider tip, guys, for the next few months, yes, pay attention to what the Fed's doing, but pay closer attention to what's happening to jobs and the labor market in our country. And that will help you know when a better time to refinance has come. So I did advise this client to wait a couple months. I don't want him to wait 2 years until rates hit a bottom, because he has a big loan amount and his monthly savings are substantial. And the missed opportunity on monthly savings in the meantime would also be substantial. So for each client, it's about assessing the situation. I want him to wait a couple months, not a couple years. So I'm going to exit Zoom for a second so I can show you a real loan estimate. Okay, so I'm going to show you a loan estimate and a closing disclosure and how to read them. So this, now all the lenders on the call, don't come at me. It's a DSCR loan, okay? I have great interest rates. So we're doing a DSCR loan for this person, and this is their interest rate. This is their loan amount. This is the monthly payment. This is where a lot of consumers just stop. They think, okay, good. This is what I was sold. But what I really need you to do is go down to the next page and look at the origination charges. Make sure that what's being charged here for points matches what you originally quoted. Also, no, every bank can charge whatever they want for processing and underwriting fees. So ours is $9.95. Again, this is an existing client, so we waived the bank fee here. If you have a waiver for that, you might see the fee disappear here, or you might see it listed here and then offset into credits over here. Then you're going to want to see what you're being charged for an appraisal. If they have any other fees that they charge, they could charge a tax cert fee, they could charge a flood cert fee, they could charge all kinds of fees. Section C is where you'll see the title company fees, and you want to make sure it was in line with what you originally disclosed. Then there's the fee to pay the county recorder's office, and then there's funding your new escrow account. So in this case, the tax bill was coming due, so we were going to pay a tax bill immediately at closing, and then we were going to set reserves aside in section G for future tax and insurance bills. So you'll see your total closing costs listed there. Estimated payoffs, this is paying off your mortgage. So you wouldn't see it itemized, but you should see that the payoff, if you asked for your escrow balance to be credited, you can, one, totally request a copy of your payoff statement from your own servicer, or ask the lender to share the copy they receive when they order it. And then you could see the breakdown of what's making up the payoff figure. A lender can't really hide fees here, so you don't have to worry about that. But if you did want your escrow balance transferred, that's where you could confirm that it was being credited to the payoff. Now, when you get to closing, it's going to be a closing disclosure instead. And then you'll see your final loan amount. Interest rate should remain the same unless you were told otherwise, like maybe you qualified for a free float down. And you'll see your monthly payment. And again, because you guys have attended this webinar, you will now scroll to the second page and check that the points, any charges from the bank, title company fees that were or weren't relevant, setting up your new escrow account, that all that is still in line and that you're still getting any credit you were promised here. So here's the thing. I think that there's a lot of amazing lenders out there.
Wait, I have a question, Shivani.
Yeah, go, Ricky.
Is there somewhere on the form where people can see if the other lender actually locked their rate or not?
Oh, you're so good. So when you look at a loan estimate, it's up here at the top, whether the rate was locked and how long it's locked through. That way you'll know if your lender is currently floating you or locking. And it's not bad if it's floating, but there needs to be transparency and conversation around that. If they told you that you were set on that interest rate and it was not going to change, then you should be expecting a locked loan estimate. If they told you they were floating because they think there's going to be some positive economic movement and you're on board with that strategy, then it'd be okay if the box is checked for no. So what I've done is I think there's a lot of great lenders out there, and I think there's a lot of lenders who will be approaching every refinance and spending the extra 15 to 20 minutes on educating their client. Because in an ideal situation, what you're encountering when you take out a mortgage, whether it's to purchase or to refinance, is you're working with an advisor who is educating you enough that you can make the right decision for yourself, that you don't have to just trust them blindly. You trusted them to educate you, and then you get to make the decision. So in a perfect world, that's happening for everybody. But the truth is, it's not a perfect world. And there is a lot of predatory lending happening right now. So many phone calls and sales tactics when the majority of us who've been in the industry know that this is not the refi boom today, that it is still on the horizon. So if you want us to just watch this for you, all you have to do is scan this QR code. I will put you on a list. I will not bother you. I will not spam you. I will not junk mail you. You're welcome to reach out to me anytime you want things to be updated. But what I will do is I will make sure you don't miss the opportunity when it comes. I will have you on my radar to reach out to first and foremost. If you're one of my existing clients on this Zoom call, good for you for coming. I'm so proud of you for continuing to educate yourself. It looks like we're off to a great start here in what I established with you initially. You don't have to sign up for this refi watch list. You're already on it. Okay. Thank you guys for coming. And by the way, all of you guys should come to our monthly webinar. There's a lot of you here and a lot of you don't come to our monthly one. It's fun. Property Pursuits, first Wednesday of the month. Hope to see you there.